Bank runs are sweeping through the system and the Fed's reserves have plunged to critical levels. Is the financial system on the brink of collapse? Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, panic is spreading as bank runs return and the Fed's reserves have fallen to dangerously low levels. Are we on the verge of another systematic collapse like we saw in March of 2023? How will central bankers and policymakers respond? And more importantly, is your money safe? Now let's head over to Bloomberg, where we picked today's story up with a headline: as reserves at the Fed sink below $3 trillion to the lowest since 2020. And I want you to keep that $3 trillion number in mind, because the one thing the Fed does not want is a repeat of the global financial crisis. We know it was centered right around U.S. banks. And since then, Fed policy has changed in an effort to absolutely mitigate that happening again. But now we're falling below absolutely critical levels that have been identified by experts, suggesting that liquidity is draining from the banking system. At the same time, we're seeing a mass exodus of money from small banks, setting up the potential for another massive banking crisis, just like we saw in March of 23. At the start of October, as we turn back to 2024, we see that the Fed's repo rate corridor, the anchor of the entire U.S. financial system, broke, and it broke as a general collateral surged almost 40 basis points above the reverse repo facility rate. Now, what does this actually mean, and why was it such a big deal? Because what it indicated is there was a massive shortage of collateral in the financial system, and this is a dangerous problem because the banking system relies on short-term collateral, or what's called treasury bills. And when there's a shortage of them, what you see is the banks scramble for them, because what it means is there's problems in the financial system. They want to hold collateral, and it drives rates up. So we see back in October, this happened once, and now it's starting to happen again. And what this means is liquidity in the financial system is draining. And let's turn to former New York Fed repo guru Mark Cabana. And according to his estimates, the lowest comfortable level of reserves is around 3 to 3.25 trillion. Now keep in mind, this is the guy the Fed turns to when they don't understand how the system works. Now keep in mind, the Fed doesn't actually know how the banking system works, but this is a key player. So when he says the lowest comfortable level is 3 to 3.25 trillion, and we've now fallen below the 3 trillion mark, well, it tells us there's major problems in the banking system that are only going to be made worse as we see money flood out of small banks, just like we saw going back heading into March of 23. And the reason he gives is the bank's willingness to compete for large time deposits and reserve/GDP metrics. Now, going back to 2019, the repo market locked up once reserves dropped to about 7% of GDP, not too far from where they're at now. So here we're in the case where we're seeing liquidity drain from the banking system. We're at critical levels, and even worse, we're seeing deposits flow out of the small banks at a time when the origination of new loans, or the creation of new money, is stagnating and even declining, meaning we're headed all into a complete crisis. The decline comes after year-end dynamics forced banks to pair balance sheet intensive activities like repurchase agreement transactions in order to shore up their books for regulatory purposes. That means cash is directed to places like central bank's overnight reverse repo facility, once again draining liquidity from other liabilities on the Fed's ledger. So just like we saw back in China, that Beijing is injecting money into the banks for regulatory purposes to make their balance sheets look good, we see the banks here in the U.S. doing something similar, not from government money being injected, but by going to government facilities to clean up their balance sheet. And sure enough, when we look at the charts of the overnight reverse repurchase agreements, we see exactly that, a big surge going into year end. Some of that has been partially reversed. We're sitting on now $237 billion of overnight repurchase agreements, and when we were roughly just around $100 billion, that skyrocketed almost to $500 billion. Now, of course, reversed in a big way as banks are trying to clean up this mess so people can't see what's really going underneath the banks. Now, I want to know from you, are you concerned that we're going to face another March of 2023 or perhaps something worse? Weigh in the comments below. Or do you believe that our banking system is sound and resilient? I'd love to know what you think, because at the same time, the Fed has also been removing excess cash from the financial system through its quantitative tightening program just as institutions continue to repay loans from the Bank Term Funding Program. So what we're seeing is cash draining from the system in every possible way. And of course, the Fed's a big player in this because they believe if they drain cash from the system, it'll bring inflation down. Now, keep in mind, everybody believes that quantitative easing, which they did for many, many years, creates inflation, although there's absolutely no evidence to suggest that. But because it's the popular narrative, the Fed's running QT to attempt to bring inflation down. But what they're actually doing is draining liquidity out of the financial system. At the same time, a lot of these small banks who borrowed from the Bank Term Funding Program are watching liquidity drain in multiple avenues. It also adjusted the offering rate on the reverse repo facility so it's in line with the bottom of the target range for the funds rate. Now, this is very interesting because the Fed's trying to get people off the overnight reverse repo program. And again, they're trying to keep money in the banking system in some regards. At the other time, they're draining it out through quantitative tightening. So you can see the policies from the Fed here really don't make any sense. It's really an indication that they don't have any clue what they're doing. And while they're focused on inflation and the labor market right now, what they should be focused is on the banking system. And that put downward pressure on short-term interest rates, and some think that it could be enough to stave off reserve scarcity for a little bit longer. But based on the trajectory of where we're seeing reserves headed, we're going into a potential massive liquidity crisis because, again, Mark Cabana said, look, we're at the threshold of the low end of what he thinks is a safe number of reserves, and that number is continuing to get drained lower as the Fed continue to push his QT. But something that shouldn't be going lower, well, that's your trading and investment accounts. Check this out. At the close of business Friday, we're batting 1,000. That's right. On our machine positioning report, CTA Timer Pro, we got 4 open trades. They're all up. And for our momentum traders, well, we got 4 open trades there. All 4 are up. And here's the best part. I trade my own reports, and you can follow right along with me. And I'm currently beating the market, and I make it easy. I tell you what I'm going to trade before I buy it, and I tell you what I'm going to sell before I sell it, and you too can beat the market. Now, how do we do that? Every day we look at machine positioning because we're looking for discrepancies. What we want to find is what machines need to buy so we can buy in before them. We give a report every day that looks across all the machine positioning. I review all the trades it recommends to tell you exactly which ones I think you should look at. And maybe you like to trade momentum, but everybody who trades momentum runs into the same problems. They get in late, they get out early, they're all over the place. We have fixed that, and we've got a big update coming from our Momentum Timer Pro subscribers. We do the same thing. We look at momentum every day. We give you a review of all the trades, and you too can beat the markets. You can trade right alongside me. You get the daily reports. You get the tradable signals. I review all the trades for you, give my opinion on them. We've even backtested our reports to show how great they are. We give you risk control levels, a full tracking of all our open trades, a weekly update. You can follow along with my trades, and here's the best part, because many people said, Steve, I'm on vacation right now due to the holidays. Can you extend the 30-day free trial? Because I'm going to come back and trade in a big way at the start of the year. We did that for you. Jump on those links in the description below. Start trading, start making money, and beat the market. Because still the debate is picking up over how much longer the Fed can keep up QT without invoking memories of September 2019. So what I want you to see here is at the same time we're seeing money coming out of the small banks, which we're going to look at here in a moment. We're seeing these policies from the Fed that they're draining money out of the system. They're draining reserves out of the system, and they're setting us up for a complete crisis. Now, when this happens, of course, we know the Fed's going to reverse policy in a huge way. But keep in mind, what happened with inflation recently? It ticked back up. What did we hear from the Fed? Well, we're concerned about inflation going up. We need to keep policy restrictive. Well, that is until you have a banking crisis, and then all bets are off. And at the same time, reserves have grown too scarce while the Fed was unwinding its balance sheet, and a shortage led to a surge in a key lending rate and the federal funds rate. The central bank was forced to intervene to stabilize the markets. Now, they should be doing something ahead of this. But again, the key is, why do we need all these bank reserves, and what are they? Well, there's a reason the Fed thinks we need them is to stave off financial crisis. They believe that the reason we had such a big problem in 2008 and 9 is because the banks did not have enough reserves, and they fixed that because if we look back at the history of reserves, well, what you see going back to the 1950s is, well, the banking system had none of them, at least not until around 2009, where the Fed said you're going to have them and you're going to have a bunch of them. Right now, we're just under $3 trillion. You can see this chart from the Fed is lagged, but you can see where this is created was through quantitative easing. So what happens when you put money in the bank and deposit it, bank has to pay interest on it, and they either have to lend your money out to get interest or they have to go out and buy what's called a bank reserve. And a bank reserve is nothing more than a treasury or mortgage-backed security. So what you're seeing is banks going out and buying bonds from the government to generate interest to pay depositors. And as the Fed does QT, well, they're draining that out of the system to what Mark Cabana says is now at a critical level. And what happened back in 2019? Well, we saw a sharp drop, and we're looking here at 6-month Treasury yields, and that was after yields had already been coming down. What happened then? The Fed cut rates, and next thing you know, we're headed right into the pandemic. But had it not been for the pandemic, we were already headed into a globally synchronized recession. Now we look at where we're at now. What do we see with 6-month bill yields? They're headed down and facing a potential move where they could substantially drop, indicating a massive liquidity crisis in the banks. And while the central bank in June lowered the cap for how much in treasuries it will allow to mature without being reinvested, it's unclear when the program will end altogether. Well, based on the direction of where we're seeing reserves, you can probably safely assume that the QT program is coming to an end far sooner than most people think, and QE will come back at a time when Fed is still combating inflation. Keep this in mind. We've seen this game before. We've seen inflation be an issue. We've seen the labor market be an issue. And next thing you know, the Fed's coming out with lower interest rates in QE, despite the fact that inflation is not at their target. One of the reasons why as well, there's problems in the banks, and now we're seeing money flowing out as small banks suffer a big deposit outflow as money market funds hit record high into year end. So what we're seeing now is depositors are looking at the interest rate they're being paid by these banks. And this is an issue, we said, because one of the problems in the small banks is they lend a ton of money at ultra low interest rates. So when the Fed raised rates, it impacted money market rates that went up, and everyone were looking at what the small banks were paying and said, why am I keeping my money here? And they shifted to money markets, and then the Fed came in and said, well, why aren't you banks competing? Well, the issue is the banks didn't have the interest rate to compete. Now we see the banks are now in the same scenario here. Money is flooding out, and that was a problem because what was the solution back in March of 2023? We'll inject the small banks with money. Now it's flowing out. And under the hood, excluding foreign deposits, small domestic banks saw sizable outflows into Christmas. Meanwhile, big banks saw inflows, possibly as depositors started to worry about the safety of their money. This is an issue and a big one because what happened, we know back in March, money flooded out in a big way and rapidly. On the other side of the ledger, both small and large bank loan volumes shrank at the last week of the year. Now keep in mind, everybody's been expecting loan volumes to surge higher on the back that the economy was going to turn around, demand was going to go up. We said that wasn't likely to happen, but why do loan volumes matter? It matters for one very specific reason, because in our financial system, money is created when commercial banks lend. So when you see a big surge in commercial lending, money is created, and that's how deposits are created. So you can see the link here. Small banks need to see a massive amount of new loans originated to create money to stem off some of that outflow. Well, what are we seeing when we look at the total commercial industrial lending data at all commercial banks? What do you find out? It's running at a scant 1.2% year-over-year rate, not enough really to provide enough new cash into the system. So it's dangerous. We're seeing money flow out of the small banks at a time when people are not borrowing in big ways. And tacking on to that is the Bank Term Funding Program, which was the bailout facility back in March of 2023. And the way this worked is banks went and took their treasury securities that were illiquid because rates had gone up and they had lost value, but they got to hold on to them. And what they did is they swapped them to the Fed for cash and then turn around and use that cash to either lend or to park in other facilities to generate interest. Now, all of a sudden, all this cash is being paid back. And that means the banks are taking back those low yielding treasury securities. And that is a problem here. You can see the massive drawdown in that facility. So not only are small banks losing cash as they pay back the Bank Term Funding Program, but depositors are fleeing as well. And what this is setting up, we go back to September 2019 where we saw 6-month bill yields fall, well, what that means is the Fed's going to be cutting rates despite the fact that inflation isn't at their target. This is something, again, we've seen throughout history. The Fed says one thing and then they do another, because at the end of the day, they don't really care about the labor market. They don't care about inflation. They care about the banks. And if there's liquidity problems, you better believe they're going to cut rates and they're going to bring back QE in a big way. This is something I predicted would happen. But let's look at what the central bankers are focused on instead of actually looking at the banks. Here we see Barkin says he prefers the Fed keep rates restrictive for longer. And this is a big problem. So you look at what he's saying here is we should keep rates high. What they need to do is lower them, because when you look at the commercial industrial lending data and you see 1.2% year-on-year growth, what is that telling you? That the demand for loans at current rate is too low. And how do you increase demand? You have to lower rates. Fed's saying we're not going to do that. We don't see a need to do that. Well, when the banking system blows up, you'll see a need. And I think there's more upside risk than downside risk, Barkin said. So I put myself in the camp of wanting to stay restricted for longer. Well, that is until I said you blow something up. And based on the direction of the reserves falling below 3 trillion, remember we talked about keep that number in mind. It's falling below 3 trillion. Money's flowing out of small banks. Small banks are on top of that, paying back those loans. More money's flowing out and not enough money being created through commercial loans. Well, you got a big problem, and the Fed is completely blind to it. And even Fed's Kugler says she's cautious about the recent inflation bump. Again, focus on inflation, not the banks. Well, I'll tell you what, if you don't have banks lending, you're not going to have inflation. You can see the priorities here are completely backwards. And she said we saw in the first quarter of 2024 there was a bump, and now we're seeing a bump again. We want to make sure that that is indeed a bump and not something more permanent. Well, it's not permanent because inflation isn't permanent. And if you don't have banks lending, you're not going to get inflation. And if consumers are drawing money out and we see another resurgence of a banking crisis like we saw in March of 2023, we can tell you what's going to happen with inflation. It's going to come crashing down, because if demand is already dropping as it is and consumers can't borrow and spend, which is how we get inflation to begin with, people borrow money they don't have and buy things they don't need. Well, what we can set up is inflation is going to hit the Fed's target and go blasting right through it to the downside, meaning you're going to see a lot of panic coming out of the Fed as they slash rates and bring back QE, despite the fact that they have no clue what's going on in the banking system. Is your money safe? Well, that's a question that remains. We don't have enough evidence to see what happens when reserves fall below 3 trillion, but we'll keep monitoring the situation and keep you updated. Until then, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.